Earning easy money on your extra funds. Everyone knows that one of the most important principles of personal finance is to build up your savings in order to have extra money on hand. However, they don't always tell you what to do with those funds once you have them. For that reason, all too many of us let our checking accounts get fat when our funds could be better used elsewhere. Don't let your money just sit there, put it to good use. Here are a few ways you can make some extra money from your savings. If you're like many people, odds are you simply keep your extra money in a traditional savings account. That's a good start. But unfortunately, the interest rates that most big banks offer are minuscule at best. In fact, several major institutions pay as little as 0.01%. Luckily, there are other options. And one of the best places to start looking is the internet. Since online banks don't have to deal with many of the costs associated with brick-and-mortar branches, they typically offer much higher interest rates to their customers. For example, online institutions such as Discover Bank, Ally, Synchrony and others offer savings accounts with interest rates as high as 1%. Additionally, many online banks provide other options like certificates of deposit, CDs, and money markets that can also earn you a return on your money. Both products are somewhat similar to savings accounts but have their own pros and cons. Starting with CDs. The biggest difference between this option and a regular savings account is how accessible your money is. CDs allow you to deposit money for a set period of time, ranging from 1 month to 10 years, in order to earn what is typically a higher interest rate. In most cases, the longer the terms, the better the rate. Of course, if you absolutely need the money you've deposited, there is a way to get it out. However, you will typically be assessed a penalty for doing so, amounting to a few months' worth of the interest you'd collected. As for money market accounts, they could almost be compared to a savings checking hybrid. That's because some banks will allow you to write checks against your money market balance, or perhaps even use a debit card for the account. The downside is that these types of accounts typically require a much higher initial deposit, as well as daily balance requirements you'll need to maintain in order to avoid penalty. With that in mind, this is really only an option for those with a large chunk of extra cash to stash. While it might seem odd to put your money into a bank you can't actually visit, technology is making it easier to live without physical banks. Many of the aforementioned online banks offer mobile apps and other conveniences, such as partnerships with ATM providers, to make accessing your money easier. However, it's important to note that there are usually limitations on online accounts, including the number of transactions you can make per month. Lastly, be sure to check that the online bank you go with is FDIC insured just in case. In terms of passively earning on your money, the 1% plus you can get from online savings accounts, CDs, and money markets is pretty great. On the other hand, if you want a potentially bigger reward and are willing to take a few risks, there are a number of ways to get started in the world of investing. Although that might sound intimidating to many, today there are several tools and platforms from financial technology, mashed together to form the incredibly cool-sounding term fintech companies that not only make investing easier, but also offer new ways to make money. One prime example of this trend is the mobile app Acorns. Basically, this application links to your debit and credit cards to round up your purchases to the nearest dollar and invest the change. What's also cool is that you can adjust your settings to choose whether you want to be more conservative or aggressive with your investments. Another growing fintech invention is peer-to-peer (P2P) lending. P2P is actually strikingly similar to crowdfunding platforms like Kickstarter and Indiegogo that you're likely already familiar with, except that sites like Prosper and Lending Club help borrowers in need of loans. Simply put, approved borrowers can have their loans funded by investors, who then earn interest on the loan. As investing in peer-to-peer lending has evolved new tools that help to manage the process, such as Lending Robot, which help to automate your loan investments. The peer-to-peer platforms themselves are also rolling out tools to manage investments. As these tools gain adoption, investing in peer-to-peer loans will likely become a more mainstream practice to help diversify investment portfolios. That said, you can still get started today with investing as little as $25 in individual loans. Interestingly, companies such as Able Lending are now combining P2P and crowdfunding so that friends and family can lend money more formally for startup businesses. For that reason and others, It's worth keeping an eye on the fintech sector for possible investment opportunities in the future. When it comes to building your savings, there are many places to put your money. Whether you prefer passively earning from online savings accounts or taking on some risk by trying your hand at investing, it's often worth exploring your options and ensuring that your money is put to work earning you even more. The journey to paying down your debt can be challenging in the best of times. It can be even more complicated when you're balancing the effects of a global recession. Many Americans are facing immediate financial uncertainty from losing their jobs or being underemployed. The economic repercussions of this pandemic recession will be felt for years to come. Although becoming debt-free might not be your top priority during this difficult phase, you should still take steps to maximize your money. The first on this list of debt consolidation tips is asking your creditors to lower your interest rates. Many borrowers don't realize they can contact their existing credit card providers at any time to request a lower interest rate. This often overlooked tactic is a quick and easy way to reduce your debt burden. And it may result in a permanent or temporary, e.g., 12 months, interest rate reduction. Creditors are more likely to say yes if you have a history of on-time payments or if your credit score has recently increased. Even if that's not the case, the worst thing your creditor can do is say no. If you aren't successful in lowering your interest rate, don't hesitate to ask again after a few months or after receiving lower offers from competitors. Credit card providers can issue reductions at their discretion, but it's up to you to initiate the request. High-interest loans and credit cards can prevent you from climbing out of debt. Although you're hard at work making payments, interest charges are continuously accruing. This interest can quickly eat away at your monthly payment instead of chipping away at the principal balance. To help make some headway in repaying your debt, see if you can pause payments on your lower interest loans. Then, devote those funds to your higher interest debt. This lets you eliminate your balance faster and save you from unnecessary interest charges. Options for loan deferment vary by lender. In some cases, lenders might offer an interest-free deferment. Other lenders might continue charging interest on your loan during deferment. Contact your lender to determine if deferment is available and for how long. Even a pause of 2 to 3 months can help you put a noticeable dent in your high-interest debt. You can quickly reduce your overall interest by taking advantage of low or 0% APR balance transfer credit cards. By transferring your existing balance from a higher interest card, you can save money and pay down your balance quicker. A low interest rate or promotional offer, however, might come with an additional cost in the form of a balance transfer fee. For example, a creditor might offer 18 months of 0% APR when transferring a balance from another card. This perk typically comes with a 3-5% balance transfer fee that's calculated based on the transfer amount. In this scenario, you could tack on up to $300 to $500 in transfer fees if you transfer an existing $10,000 balance to a new card. You'll need to weigh your potential savings versus the transfer fee to determine if this is a good debt consolidation strategy. Additionally, your new card might have transfer limits or a short introductory period before a higher interest rate kicks in on any remaining balance. Be sure to read the fine print and stick to your repayment strategy, so it doesn't end up costing you more in the end. Whether it's your mortgage, student loans, auto, or other consumer debt, you might find a lower interest rate by refinancing your loan. Refinancing is one of the most helpful debt consolidation tips you should know. Refinancing replaces your existing loan with a new loan, usually with a lower interest rate or better terms. You might qualify for a better rate than when you originally took out the loan if your credit score has since improved or if consumer loan rates have dropped. Mortgage and student loan refinancing rates are at record lows since this pandemic began, which is a small silver lining in otherwise tragic health and economic crisis. The bottom line is if you can find a lower interest rate for any of your loans, take action. Remember, there might be associated refinancing fees or closing costs depending on the type of loan and lender. In some cases, you can benefit from modifying an existing loan instead of refinancing it into a new loan, particularly if you need immediate relief due to financial hardship. Depending on the type of loan, the refinancing process can take months, as is the case with some mortgage refinancing options. Loan modifications, however, can be processed in a short period. Loan modification can make your payment more manageable by reducing your interest rate or lowering your monthly payment. It can also extend your loan terms, which typically costs you more money in the long run. Contact your lender to explore loan modification opportunities. Always make sure you fully understand the terms and structure of your modified loan before moving forward. If you have high interest debt, you may be able to consolidate multiple balances into one low interest loan. This can save you on interest fees. But it can also streamline your payments into one due date, which can prevent missed or late payments. It's best to grab quotes from at least 3 lenders anytime you're consolidating or refinancing your debt. By comparing multiple offers, you're getting the best current rate since lenders are competing for your business. I recommend shopping around for all types of loans, especially for better student loan rates. Student loan debt, totaling more than $1.64 trillion in both federal and private student loans, surpasses all other forms of debt in the U.S., apart from housing debt. Because of this, there are plenty of opportunities to refinance or consolidate your student loans. If you already have private student loans, you should be shopping around for better interest rates at least once per year. Lowering your interest rate is the priority. But also compare origination fees, repayment terms, and any available cashback offers to pay down your debt further. If you have federal student loans, the decision gets more complicated. Depending on your financial situation and career goals, it might be more advantageous to keep your existing federal student loans due to their various protections, e.g., deferment and forbearance, flexible income-driven repayment plans, and available forgiveness programs, before consolidating a large amount of debt. Take steps to improve your credit score. The higher your credit score, the better interest rates you'll be offered. These actions can help lower your credit utilization rate while maintaining your credit history length. Both are important factors in determining your credit score. Another often overlooked debt consolidation tip is canceling small credit cards. If you use a debt management program or a debt consolidation loan, you might be required to close certain credit card accounts as part of the agreement. This gives the lender more confidence that you won't run up new balances and increases the likelihood that you'll repay the debt. Even if you choose a different method of consolidation, it's a good idea to cancel your smaller or newer credit cards by choice, or cut them up, to discourage you from using them. With endless opportunities to borrow money, payments can slip through the cracks. Check your credit report periodically to ensure you haven't forgotten about a small loan or debt. For example, you may find that a medical bill has been sent to collections without ever physically receiving a notice because it was sent to a previous or incorrect address. Perhaps you simply forgot about a loan that has an old email on file. You could be in default without realizing it. You're entitled to one free copy of your credit report from each of the major credit reporting companies, Equifax, Experian, and TransUnion, every 12 months. By keeping an eye on your credit report, you can head off any surprises and actively resolve any financial issues that arise. An often overlooked debt consolidation tip is signing up for a budget tracking service. It's easy to become detached from your money when you're swiping your credit card instead of paying with cash. This psychological separation leads to overspending and more debt. Free and paid budgeting tools can help you reconnect with your finances and keep you accountable along your journey. Platforms like Mint or You Need a Budget (YNAB) can help track your expenses and give you a big picture view of your finances. There are many free and paid budgeting tools out there. So find one that matches your financial needs and goals. Although these debt consolidation tips can help you save on interest and streamline your debt payoff strategy, it's only one piece of the financial puzzle. If you're spending more than you're earning, you'll continue to get trapped in the debt cycle. Start by setting a realistic budget, which might include significant lifestyle changes. You might need to trim down some of your expenses or find a way to bring in additional income. By relying less on credit to make ends meet, you'll reduce the likelihood of repeating the debt cycle. Text source: lifehack.org.